Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question from the topic non-current assets. In this question, you will understand the differences between the capital and the revenue expenditure. You will also calculate the depreciation expense for multiple assets. Lastly, you will look into the accounting theories that justify the recording of depreciation expense. You can see the question on the left-hand side of your screen, and on the right-hand side, we have got all the workings which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Vanessa Pottery buys and sells vases. It provided the following information on its equipment on 1 July 2021. So we are given the cost of the asset, which is $36,000, and then you are given the accumulated depreciation for this asset, which is $3,600. The accumulated depreciation means the total depreciation expense that we have incurred for the asset since the day of purchase. On the 1st of August 2021, the business bought another asset for $25,000 on credit from HP Company. The business depreciates its equipment at 10% per annum using the reducing balance method. A full year's depreciation is charged in the year of purchase. All right. Now, based on all the information that's given to us, let's answer the first part, which is to give two differences between capital expenditure and revenue expenditure. So we understand the meaning of capital expenditure, which is to buy a non-current asset. So anytime you purchase a non-current asset, it is a capital expenditure. Also, anytime you make improvements to a non-current asset, which increases its efficiency and also the economic output that you can utilize in your business from that asset to help you generate more revenue. So that's like kind of adding value. So capital expenditure is mainly when you buy a non-current asset and also when you add value to an existing non-current asset. So these are the two criteria that are involved when it comes to defining capital expenditure. What about revenue expenditure? Revenue expenditure simply refers to the day-to-day operational expenditure for the business. So business has all these regular expenses on a daily basis. One of them could be utilities. It could also be telephone bills. So any expenses that are incurred during the course of operations to help the business fulfill its purpose and generate more revenue, those are classified as revenue expenditure. In this case, when you have an asset such as a motor vehicle, you would also involve repairs expense as a revenue expenditure, but the cost of the motor vehicle in itself would be classified as a capital expenditure. Okay? All right. Now let's answer part B. Calculate the depreciation expense for the year ended 30 June 2022 and show all of your workings. Okay, so based on the paragraph that is given to us, we know that on the 1st of August 2021, the business bought a new asset, all right? And the cost of this new asset is $25,000. And based on the business policy, as mentioned in the very last line of the question, the business applies a full depreciation in the year of purchase. So regardless of when the asset was purchased in the year 1 July 2021 and ending 30 June 2022, we are to find the depreciation as if we are doing a full depreciation. So full depreciation in this case is simply the percentage multiplied by the original cost. The percentage is 10 and the original cost is $25,000, which gives us a full depreciation of $2,500 for this new asset for the financial year starting 1 July 2021 and ending 30 June 2022. Now, what about the old asset? Now, when it comes to the reducing balance method, we always want to make sure that we also find the net book value. The net book value simply stands for the economic outputs that are still available for consumption from that asset. So based on the cost and the total depreciation given at 1 July 2021 at the beginning of the question, we can find the net book value at 1 July 2021, which is the difference between the original cost and the accumulated depreciation. The original cost is $36,000 and the accumulated depreciation, as you know, is $3,600, which gives us a net book value at 1 July 2021 to be $32,400. All right, now that we know that, using the reducing balance method, when you know the net book value, you can find the depreciation by simply applying the given rate with the net book value. Now, the rate is 10% and the net book value, which we calculated, is $32,400. That gives us a depreciation of $3,240 for the old asset. So the total depreciation expense for the financial year ending 30 June 2022, including the old asset and the new asset, is $2,500 for the new asset, plus an additional $3,240 for the old asset, which gives us a total amount of $5,740. Okay? All right, so I believe that is clear. Now let's move to part C. State the effect on the profit for the year ended 30 June 2022 if the business uses the straight line depreciation method at 10% per annum on cost. All right, so let's start with the new asset. Now, the new asset, because it is in the first year of usage, regardless of whether you use the straight line or the reducing balance method, the depreciation will be derived as the given rate multiplied by the original cost. So the given rate is 10% and the original cost is $25,000. So we get a depreciation of $2,500 using the straight line method, which is the same as the reducing balance method. All right. Now, what about the old asset? Now, the cost of the old asset was $36,000, right? And the depreciation, now that we're using the straight line method, is to be simply calculated by multiplying the given rate of 10 with the cost of $36,000, which is $3,600. So unlike the reducing balance method, where we find the depreciation in the next year as the percentage multiplied by the net book value, using the straight line method, we understand we just simply multiply the percentage with the cost, which gives us a depreciation of $3,600 for the old asset. So altogether, the total depreciation expense for the year ended 30 June 2022 using the straight line method is $2,500 for the new asset that we have bought and $3,600 for the existing asset from previous years, altogether which gives us $6,100. Now the question is clearly asking us to state the effect on the profit if we adopted the straight line method. Now, we know that using the reducing balance method, our depreciation was $5,740, but using the straight line method, it's $6,100. So the difference between the straight line and the reducing balance values is simply 360, which is 6,100 minus 5,740. What this means is that expenses are overstated by $360 using the straight line method, right? Because of the high depreciation that we have shown. So because expenses are overstated by $360, the net profit is therefore understated by $360 because profit, as you know, has an inverse relationship with expenses, which means obviously if expenses go up, profit is to go down. Okay? Now, what about part D? Name and explain the accounting theory applied when the business provides for depreciation on the non-current assets. Now, we could look into many theories. Let's start with the accrual theory. Now, the accrual theory simply states that revenue is recognized when earned, not when cash is received. All right, so if you have made some sales on credit, or if you have provided some services on credit, you have already earned the right to that specific revenue, right? So regardless of whether you receive the cash or not, you're still going to count it as your revenue because you have fulfilled your obligation as the business owner. Then we have got the expenses, which we record as their income, not necessarily when cash is paid. So if you think about depreciation expense, when do we incur depreciation expense? Let's first understand the definition of depreciation. The simple definition of depreciation is the cost allocation over its useful life. So if an asset costs you $30,000 and we have a useful life of 10 years, every year we look forward to consume $3,000 in economic value, right? And we want to transfer that consumption of economic value into some kind of revenue generation for the business, because that is the only purpose of buying assets in the first place. Now, as these assets get used within the business to help the business achieve its goals, what happens is that the asset loses its value, which is what we classify as a depreciation and as an expense that is incurred when we are doing our regular businesses, which is to make sales and generate money. All right. Now, you could also talk about the prudence theory, because within the prudence theory, we have clear specifications regarding expenses never to be understated and assets never to be overstated. So when you think of any non-current asset, as it gets used within the business, we want to make sure the consumption or the cost that we have already consumed from that asset is recorded separately, and the remaining economic value or the net book value is kept separate. So that way we don't understate our expenses, because we have got our depreciation expense, which has captured the consumption, and then we have got our assets, which we don't overstate, because we're only showing it at net book value, as you have seen already, I believe, in the statement of financial position or the balance sheet. Okay. All right. So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel, share this video with your friends. And also, if you would like to join our coaching program and achieve the best results, you can check the link in the description, and I'll see you in the next one.